So I'm going to begin with understanding consumer protection laws and how this is helpful for you as a consumer, right? So what you should know about consumer protection laws and regulations, including how to protect yourself financially if a bank fails, right? So if a bank financially fails, as we all experience in 2023, with the banks are just jumping ship and they had some bad investments, right? And so it affected the deposits in those banks, and what happens? The government comes in and protects the customers. So as a consumer, they will protect your assets as much as possible up to a certain limit per person, which we'll discuss as well. So the great thing about regulations, as you know, New York State is highly regulated. There's regulations in banking, in medical, in constructions. There's so much regulations, and that's really to protect you, the consumer. We are consumers, whether we like it or not. We consume. This nation is it's we're consumers, so we need to get protected. Why? Because there are people out there who are taking advantage of certain individuals or certain groups of individuals financially to gain something financially from them. So regulation is a good thing, is to protect you as a consumer. In this case, we're going to talk about consumer like bank accounts, obviously. And one of the regulations that one has to remember are these four major regulations. Again, there's so many regulations, but we're going to touch base on four that we believe that you should know as a consumer. One of them is called truth in savings, right? The other one is called electronic funds transfer, expedited funds availability, and FDIC deposit insurance regulation. So truth in savings, we call it TISA for short, requires financial institutions to tell you the terms of deposits, such as checking and savings, promote competition among other financial institutions, and it makes it easier for consumers to compare interest rates, fees, terms associated with deposit accounts, intended to help consumers make an informed decision. Well, that helps you, right? So when you're going shopping, I remember before the internet, we would go to banks and pick up their disclosures, right? And we would look at the disclosure and figure out if this checking account or this savings account or this CD account is beneficial to me. And so we will go bank to bank and they say, okay, I like this bank, I like that bank. Once you see the regulation, now you say, okay, do you like the location? Do you like customer service? That's not part of regulation. But the TISA, in this case, Truth in Savings, allows you to decide, okay, the interest rate in this bank, Bank A, is better than Bank B. So it helps you make that decision. And that's before you open the account. You ever open an account and then all of a sudden you got hit with all these fees and charges and that you were not made aware, either by two ways. One, the rep didn't tell you verbally, and two, you didn't get a Truth in Savings Act disclosure. Now, even though it says Truth in Savings Act, it does protect checking accounts and money market accounts. So even though it says Savings Act, is really the checking, the money market, the CDs, protection. So when you go to a bank, make a sound decision. Another regulation that one has to remember is Expedited Funds Availability Act. So Expedited Funds Availability Act limits the time a bank can hold check deposits in your checking account. It's intended to standardize handling of deposits holds among all commercial banks, mutual savings banks, credit unions, savings associations, savings banks. It helps protect against fraudulent activity. Now, some of us would say that's only protecting the bank. Yes, but it also protects the individual. And the reason it protects the individual is because somebody can trick you into depositing a fake check. And since as a manager of 30 years, banking in 30 years, I've seen people get swindled from everyday person, right, to lawyers. I mean, I've seen lawyers take a bad check and deposit into the account, and they got burned 3,000, 5,000, because unfortunately, they get scammed, and that's what it's called, a scam. A scam is a con artist who knows how to talk and knows how to trick you. And so what happens is, by us putting banks, and when I say us, banks, put an extra hold on your account and not making your check available too quickly, it protects you, because by the time the bank gets it at the other end, they'll say, oh, this check is counterfeit, this check is bad. They return it back to us. We return it back to you saying unpaid, and nobody loses any financial loss to the bank or to yourself. So availability expediting funds is a good hold. It's a good regulation. And that's to protect you really from bad checks. Like I said, there's so many scams out there. Now, years ago, when I first started banking 30, well, I don't like this person. I don't like how this person looks, dress. You know what happened? They put 5-day holds, 6-day holds, 9-day holds, 15-day holds. There was no consistency between banks. Like if you, back in the days, 20 years ago, somebody had a check from a relative in California. They mail you a check. It says Wells Fargo. Wells Fargo is in California. They deposit in New York. The banker said, I'm going to put 9-day holds or 10-day holds. Those days are gone. Everything is consistent. You got to have consistency in banking. So this helps. This rule, this regulation helped us put that away. No more judgments, no more whatever you feel like it. You have to follow the rules. So when you go to a bank in the branch, always look for a sign on the wall, and it tells you how long a check is going to clear, right? Now, are there exceptions to the hold? Yes. Somebody who just opened an account, banks can put a hold for 9 days. If a person bounces a lot of check deposits or writes checks and it's always overdrawn, can you put a hold? Yes. So there is some room there to put holds on accounts. But for the most part, every bank has to follow this rule, this regulation, and clear checks within 2 to 3 days. Another act to remember is Electronic Funds Transfer Act, also known as EFT. Again, everybody who's used a debit card and some bodega or some internet website, somebody copied your card and they skimmed it and it was a skim device. Well, you have a rule that protects you. This EFT protects the consumer. EFT, Electronic Funds Transfer Act, protects you from unauthorized transactions. So if someone uses your card unauthorized, guess what? You file a claim with the bank. We go after the perpetrator through MasterCard or Visa, whoever it is, and they would make amends. They will make your corrections. They'll give you back your money, or they'll let you know they have 10 days to credit your account. So in the banking side, technically it's 10 business days before the bank decides to give you provisional credit. And basically provisional credit means based on what your written claim, because you could tell me over the phone and I can start the investigation. But some banks, when it comes to debit cards, you need a written consent, a written form, depending on the bank itself. And then that written request allows us to go after the merchant who put through the transaction through either Visa or MasterCard, whoever we have on the logo on your card. And then on the 10th business day, the bank has to resolve that fraudulent transaction. If they can't resolve it in 10 days, they'll give you credit, right? Provisional credit. And then they'll investigate between 45 to 90 days, continue going back and forth with the other bank. Hey, this is unauthorized by internet or a sales receipt. And the banks have ways of confirming if the transaction was legitimate. What helped with this EFT rule is that the banks came up with the chip. Everybody has a chip on their credit card, right? Who doesn't have a chip on their credit card these days? And that chip that's on your credit card is to help the merchant identify that the card was swiped or was present. So it's important that chip on your card actually helps the banks decide, well, your card was used without a chip. It's possible that somebody copied and made a bogus debit card. Moving on to FDIC deposit insurance regulation. As you know, a lot of banks, when they fail because they have poor investments, you're protected up to $250,000 as a person. So as a person, $250,000 is allotted to you by the Federal Deposit Insurance Corporation, basically the federal government, right? So up to $500,000. So the $250,000 will continue to increase based on how many people are in the account. right? So there are ways of getting protection up to like a million two, right? Depending how many people are listed on your account. Now, I'm going to talk about a little bit. I'm going to break it down a little bit on that a little later. So as you know, that regulation was made to encourage you and me to be confident that when we put money in the bank, when we have direct deposit going into a checking account, savings account, we have CDs, we're feeling confident that the bank is not going to fail. We don't need to take the money out of circulation, right? We're not going to take it out and then go to another bank and try to go from bank to bank to get coverage. When the crisis happened, and I don't know if anybody remembers trade your junk card. Does anybody remember that? When the um, automobiles industry was not doing so well, and they were putting that phase in with get rid of your old cars and get a new card. That's to stimulate the economy, right? Because too many people were holding on to their old cars that were lasting a long time. They were holding on to junk cars, they called it. And then when you buy a new car, you're getting a loan, you were financing it. That created that whole movement. But then it also, a lot of people were moving money out and they needed that confidence. So the government has that federal regulation protection to allow you to protect your funds up to 250. So, you know, what type of accounts are protected under the FDIC regulation is your checking account, your savings account, your CDs, your money market accounts, and what's special is individual retirement account.